That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action for today's trade. Chad Morganlander, Washington Crossing Advisor, Senior Portfolio Manager, as well as Yahoo Finance's Jared Blickery, joining us here to break down the moves today. Jared, let's start with you on that close.
Well, the big moves today were not in the indices, and I'll just go through those real quickly. Dow Jones down 33 points or 8 basis points. NASDAQ up almost 7 points or 3 basis points. And the S&P 500, we're just going to call that flat right there. Do see a little bit of positive action in the small caps. The S&P 600 is up 17 basis points, but not even 0.25% there. We went over the bond movements before, so let's take a look at the sector action. And we see some red here, some green. Industrials took the top spot, up about 42 basis points. Consumer discretionary and tech and financials also finished in the green there. Real estate, the biggest detractor from the overall gains, down 1%. Energy and communications services and materials all tied for about 0.6% to the downside. And if we take a peek inside the NASDAQ 100, we see a mixed board here. So Nvidia, Amazon, Tesla, some of those bigger names, they did manage to close in the green. Tesla up 1.4%. Meta to the downside 2.25%. Another big loser here, Intel, down about 3.5%. But aside from that, really not seeing a lot of outsized movers either to the upside or to the downside here. And if we take a look inside the Dow, we see a very similar story play out. A little bit of dark green. We got Cisco up 1%. So is Caterpillar, Disney, United Health up 1.5%. We have seen healthcare come back recently from the doldrums in which it's been for some time now. And here's the transport. These are the Dow Jones Transportation Index components. Uber, the biggest one there, up 1.5%. Airlines not doing too bad. Delta up 1.5%. So is United. And then Avis up about 2%. And I think I'll take a look. I'm going to dive into our retail. That was one sector that was doing pretty well today, and we'll see if I can find that. Let's do this. We're going to do clean air first, and this covers some of the solar plays that we've seen really ramp to the upside here. And just because I want to show some consistent dark green, First Solar up almost 10%, ticker run up 11%, and we'll see if I can find that retail ticker. There we go. And there we go. Some of the big box doing well. Walmart up 0.7%, Costco up a little bit more than that, and TJX up about 0.3%. Send it back to you.
Thank you, Jared. Chad, your thoughts on the latest moves today? What'd you make of it?
Today's typical summer doldrum, listless trade, directionalist. What we would look at is the Walmart numbers, Home Depot numbers, and TJ Maxx numbers. And then the market's going to square their book going into the weekend, looking at what happens with Jackson Hole. So their big concern there is that perhaps it will be a letdown. We think that they're going to open up, at least signal a natural bias towards lowering interest rates, but they're also going to take heat from the president and the current administration that they're not going further with the reduction of rates.
If the market was disappointed by what they hear from Jay Powell, would you expect, and let's say we see a pullback, would you expect investors to move right back in?
I don't think the wheels will come off the bus. I do think that there will be a modest pullback, maybe 3, 4, 5%. But overall, you have the wind at our back when it comes to earnings. The GDP numbers are somewhat resilient, and the whole market is being priced for capital investment going into 2026, 27, and 28, and productivity. And that perhaps is going to continue to perhaps put a floor on downside risk at this point in time.
So if you're looking broadly, Chad, and you say, okay, earnings are solid, economy looks resilient, what would be on Chad's wall of worry? What would be the risks we need to think about, the concerns?
Well, the concerns are pretty apparent that if the housing market was to roll over, the consumer was to roll over, and that the Federal Reserve would be late to the game, that potentially that would be a concern. We don't see that right now. We're equally weighted within our risk on our portfolios, and we would just be mindful that investors should look more at the equally weighted indexes as opposed to the S&P market cap weighted index, as you have 20 of the largest stocks representing nearly 50% of the market cap. Some of those companies, their valuations are completely out of whack, which is reminiscent of what happened in the 90s. We don't think we're there yet, but we're getting pretty darn close to those type of valuations on certain groups within the market.
All right. Well, let's get more perspective on this market. We're in the back half, of course, of second quarter earnings season. The vast majority of the S&P 500 companies already reporting. Here were some takeaways. We had Lori Heinel, State Street Investment Management Global CIO. Lori, it is great to see you. So let's talk earnings, Lori. We had some well-known names reporting shortly here, of course, are Russia retailers this week. But I'm curious to get your high-level thoughts on the Q2 earnings season, Lori. What did you learn? What were your big takeaways?
Yeah, so the big takeaways are that earnings momentum is really with us right now. We'd seen some downgrades of earnings expectations in the earlier part of 2025, but over the past few months, as we've gotten some of the worst case tariff scenarios behind us, and we've had other things like the passage of the One Big Beautiful Bill, those earnings expectations have started to creep up again. And if anything, we've seen this season be particularly good as we've beat across the board.
Lori, a rush of retailers are reporting this week, very well-known names. Just broadly, Lori, as they report, look at those prints, you're going to listen to those calls. What are you going to be listening for, Lori?
Well, there are a couple of things that are going to be super important. First and foremost is anything from a top line perspective, because it's one thing when earnings beat, but we're going to want to see some momentum in the top line sales figures. The second thing will be, how do they talk about the impact of tariffs? And we're of the view that the impacts are likely to be pretty modest, but they are likely to be concentrated in certain areas of retail. So watching for those kinds of signs. And then the other is what their strategic priorities are. How are they deploying capital? Are they seeing this as an opportunity where they want to make investments? Are they seeing this as opportunity where they actually want to consolidate? So those kinds of things will be important as a signaling mechanism for the balance of the year.
You say here, Lori, you recently added a risk back in the portfolios, you're increasing allocation to equities and high yield bonds. How come? What are you seeing, Lori, out there broadly that motivated that?
Yeah, so first of all, we started to add back some equity risk several months ago, especially as we got past that worst case sort of trade period in early April, because we started to see that momentum was improving, consumer sentiment was improving, and the U.S. economy in particular was proving very, very resilient. So we started to add some equity exposure earlier in the summer, and we've been a beneficiary of that. But as we've seen these earnings come in even more positive than had been anticipated, that gave us some additional confidence that there's more room to run from here. So we're now at one of our higher overweights to equities in a balanced portfolio that we've been all year.
Chad, I want to bring you here as well. So listen, earnings solid, economy resilient. How much of that is priced in here, Chad? How do valuations broadly look to you?
Well, it depends on what market we're talking about. The S&P 500, we believe, is fully valued, and we'd be somewhat more circumspect about taking that more concentrated risk. We'd be looking at the equally weighted index, which has a forward-looking multiple closer to 19 times. One, though, has to be mindful, like I mentioned, that credit spreads are historically tight, equity risk premiums are historically low, and one just has to be a little bit more concerned about the higher volatility trade, because as the Federal Reserve goes into Jackson Hole, any kind of disappointment can scotch that high vol, high beta trade.
Lori, what do you think? Chad sees the SPX is fully valued. Do you agree with that?
Say that it's very highly valued, but I think given the momentum in earnings and given some of the other positive things that are likely to manifest over the course of the year, including continued benefits from investment in AI, continued sort of removal of some of these concerns about high tariffs, we've got a lot of fiscal spending still coming into the economy. Consumer health is quite strong. So our view is that there is still more room for the market to run from here.
So, Lori, generally in the stock market, how do you want to be positioned? Where do you see the opportunity?
Yeah, well, there are a couple of things. I would agree with the idea that a broader, more equally weighted index is quite attractive because it does reduce some of that concentration risk that you have. So we have been talking to clients about extending into areas like small cap, for example. We've also been talking to clients about looking at emerging markets. That's an area that could actually benefit and is relatively attractively priced. Again, a small position, but a meaningful one nonetheless. And then last thing we've been talking to a lot of our clients about is looking for some other places where they can have some diversification. So things like gold, for example.
Chad, what do you think? Small caps, emerging markets on your radar as well?
International is in our asset allocation portfolios. We're overweight EM as well as developed. We've taken that from growth as well as value here in the United States. And again, I'm not a perma bear. I'm just being more mindful about certain valuations of certain pockets of the market, in particular that high beta trade that really started back in April. It's around 2 or 3 standard deviations from the norm.
Lori, final question for you. Jay Powell, Jackson Hole this week. What are you listening for?
Well, we'll be listening for anything that suggests he's still waffling. Obviously, our view for many, many months now has been that the Fed should have already continued their easing cycle. And certainly at the last meeting when you had some dissent, coupled with some of the more favorable numbers that we've seen over the last couple of weeks, suggests that they should move in September. So anything that continues to call that into question will be something we'll be watching carefully.
Lori, thank you so much. Appreciate your time as always.
Yeah.
And Chad, thank
Thanks.
you as well for joining us today. Any parting thoughts, Chad, for the viewers?
Just look at being a little bit more balanced within one's portfolio. I know that there's been a lot of excitement within the market. More volatile stocks have really crushed it and ripped the cover off the ball since April. You may want to scale back, just right size that in your portfolio, and just be mindful about permanent impairment of capital. And what that means is that back in the dot-com era, there were companies that went from 100 down to 50, down to 20, down to 10, down to 0. You just want to be mindful to buy high quality companies that are more growing, profitable, well capitalized, and more resilient.
Chad, great to have you on the program. Thank you, sir.
Thank you,
Appreciate
sir.
it. Palo Alto Networks fourth quarter earnings just now crossing the wire. We had that stock popping 6%. The numbers, they report Q4 adjusted EPS of 95 cents. I do not see compare there yet, but let's look at the top line here. Q4 revenue, $2.5 billion. That is in line. It looks like consensus was $2.5 billion. Looking for forecast here. They see Q1 adjusted EPS. They're calling for between 88 cents to 90 cents. The street was at 86 cents, so that helps explain this, at least initial pop in the after hours. We're going to be talking to an analyst shortly about this name and what to listen for on the conference call. That's coming up after this. Stay tuned. Palo Alto Networks reporting fourth quarter earnings just moments ago. The company reporting revenue in line with estimates. While looking ahead, Palo Alto providing a better than expected earnings outlook. For more, let's bring in now Matt Hedberg, Managing Director and Head of Global TMT Research at RBC Capital Markets. Matt, great to see you. So listen, Palo Alto reports, Matt, this stock is surging more than 6% here in the after hours. What do you make of the print, Matt?
Yeah, I would say, there was, subsequent to the CyberArk acquisition from late July, there was a lot of negative sentiment. Shares were down about 15% most recently here. And so, we see a slight beat actually to consensus revenue. NGS, which is the next-gen security piece of their business, grew 32%, a lot better than expectations. And earnings topped for fourth quarter. So that was certainly a part of it, but the guide was also better than the street expected.
What is driving that, Matt? As you look through the report, and obviously you're going to have more questions on the conference call, what's giving them the confidence? What's driving that guide?
Yeah, I think, if you look, the year, they exited the year with 24% growth in remaining performance obligation, or RPO. Seemingly that gives them pretty good visibility for the upcoming fiscal year. Let's face it, the cyber landscape is complex. There's a lot of questions out there right now from a security efficacy perspective. And I think, the overall demand environment seems strong. There's clearly, there's the pending acquisition of CyberArk that I think the market will have questions on the call. But, seemingly the exit of the year from a position of strength, and that's apparently spilling over to their guidance outlook.
The acquisition of CyberArk you mentioned there, Matt, it's interesting because I see some of your colleagues on the street, they seem to like it. They say, listen, smart move, high quality asset, that's a benefit to the portfolio. I see others raising questions. They mentioned execution risk, Matt, the price paid. Where do you come down on it?
Yeah, listen, CyberArk we think is a unique asset. Certainly a bold move for the company to announce a deal. It will take quite some time before the deal, perhaps goes through. But we've long thought, and we've written that Palo Alto seemingly lacks an identity solution. And so to us, it fills a very important gap in their portfolio. We think, relative to our other firewall peers, it could put them at a potential advantage as well. And so clearly it's a large deal. There is integration risk that you spoke of, but from a technology perspective, we think CyberArk is in a rather unique position, and it will really come down to execution and how well they can integrate it into the broader platformization strategy that the company has.
What is Palo Alto's place, Matt, in that broader cyber market? As it competes there, you think about Fortinet and Checkpoint. What are its competitive advantages? What does Palo Alto bring to the table that's different?
Yeah, really, since Nikesh got there several years ago, it's really been about expanding the platform, expanding the portfolio. We've long thought and written that there's a lot of cybersecurity sprawl. And so Palo being in a position to consolidate spend, we think puts them in a rather unique position, even relative to some of their firewall peers. We think that over time, the number of cyber vendors will continue to proliferate. But on the flip side of that, a lot of companies struggle with vendor sprawl. They want to do more with fewer vendors. We think Palo, from a platform perspective, is in a really unique spot to consolidate spending. And now, with their platformization bundling strategy, we think they have some of the sales motion to complement that product strategy.
I'm curious, Matt, for the software names you cover, the cyber names you cover, have you seen evidence, Matt, during this earnings season of macro impact, tariff impact, just in terms of deal push out or longer sales cycles?
We cover quite a few names in the space. There's been evidence of some macro pressure. Most CFOs have been guiding rather conservatively. Obviously, there's a huge focus on the U.S. federal year end in September. So there's a lot of outstanding questions about, how does DOGE impact year-end federal spending. But to this point, macros have been fairly consistent. We've actually seen higher levels of beats really since late 2022 from a software perspective. We've seen accelerating beats even relative to the past several quarters. So, at this point, individual companies have certainly been impacted more than others, but by and large, it's been relatively muted thus far, the potential impact of tariffs and things.
Matt, of course, investors very interested, excited about that mega AI trade and trend. How is Palo Alto leveraging that technology, Matt?
Yeah, Nikesh has talked about this for a long time. I mean, they candidly have been focused on AI before generative AI became a term, and a lot of times it leverages data. There's oftentimes data sprawl, and you miss elements of a cyber efficacy with too many data points. And so they're really in a position, we think, to help companies see through the noise, if you will, find the needle in the needle stack. And oftentimes it's things that you don't see that hurt you. And we do think with Palo's strength, the breadth of the platform, as well as, potentially the CyberArk deal closing, we think it gives them a really unique perspective on cyber sprawl and data. And ultimately, the story that they're trying to tell is consolidate with Palo. You'll be able to feel more secure in that overall analysis. And that's really the story.
I want to get you out of here on this, Matt. Just looking ahead, another name you cover, CrowdStrike, earnings on deck. They're reporting August 27th. I know you like that name as well. What do you expect to hear?
Yeah, it's another name that, if we talk about the consolidation play in cybersecurity, CrowdStrike's also been in a position to consolidate cyber spending. And we think that is really based on the strength of their platform. We think the platform is in another unique spot to consolidate cyber spending. And so there are clearly questions on U.S. Fed for for CrowdStrike. That'll be a big focus of the call. But we do think that underlying cyber trends remain rather robust. And we do think these consolidators are in a rather unique position relative to point-based cyber plays.
Matt, always great to see you and to have you on the show. Thank you, sir.
Appreciate the time as always.
Time now for To Watch Tuesday, August 19th. Starting off on the earnings front, more big names reporting on Tuesday, including Home Depot, Viking Holdings, and Toll Brothers. Home Depot announced results for the second quarter before the markets open. Analysts expecting same-store sales to rise about 2% in Q2. That would be just the second increase in the last 10 quarters for the home improvement retailer, driven by store expansion and strong customer activity. Moving over to housing, we're going to be getting some fresh housing data on Tuesday with housing starts and building permits. Economists forecasting housing starts to dip in in July to an annualized rate of 1.3 million, while building permits hold steady at 1.39 million, meaning less new homes are being built and future construction plans are stalling. And taking a look at the Federal Reserve, some new commentary coming on Tuesday from Fed Vice Chair for Supervision Michelle Bowman. This is coming after a busy week of economic data with inflation front and center. Kansas City Fed President Jeff Schmidt saying that increased tariffs appear to be having only a limited impact on inflation, but that's reason to keep policy on hold and not to ease.